Hi and Assalamualaikum everyone. I am Nur IZZHARITH binti HAFIZ, metric number 2023675384, and in this video, our group will discuss the challenges of audit in different industries. Important question, do you know what these challenges are? Well, in audit, different challenges arises depending on the industry that is being examined. Although the same auditing standards are applied across all sectors, the nature of the business operation, risks, and financial processes can vary. For instance, the retailing and manufacturing industry face distinct audit challenges due to differences in transaction volume, inventory management, and how they operate. Understanding these differences is important to identify the risks and to apply appropriate audit procedures. I'll pass this to my group member, AFIFAH, to explain more in detail.
Thank you, ADLINA. Hi, my name is AFIFAH binti ZAINUL AMAN. My matrix number is 2023667898. Now, I will explain in details about challenge of audit in manufacturing industry. The first key issue here is that time-consuming physical inventory count due to large and complex inventory volumes. During external audit, auditor required to observe or test physical inventory counts to verify existence and accuracy of inventory, which can slow down both audit work and company operation. This issue is critical because extended and detailed inventory counts can increase the audit risk. Under temperature, errors such as miscounts or omissions may increase. If manufacturers are not counted at year-end, the auditors may rely on roll-forward or rollback procedure, which require more testing and professional judgment. As a result, increase in audit costs, effort, risk of material misstatement, and reducing overall audit efficiency and reliability.
No, that's a good argument, Afifah. Hi, I'm AMANI binti NORSAM, matrix number of 20236881 and 562. So when we look at the physical inventory counts in manufacturing, we realize their strength is credibility, as seeing the inventory physically gives them strong evidence. However, the weakness is that auditors don't control the timing. So when the production continues at year-end, auditors rely on the alternative procedures under ISA 501 and 330. To us, this shows that even strong audit procedures can lose reliability when practical constraints exist, making the professional judgment more important than the procedure itself.
The next major challenge is poor inventory management. Some manufacturers are weak in inventory controls, inconsistent in records between warehouses, and poor labeling of materials, which may lead to audit complexity which require auditor to pursue additional observation and testing. When inventory controls are weak, auditor cannot rely on the system and must perform additional substantive testing, such as larger sample size and manual reconciliation. This will increase the cost, audit time, and signals a higher risk of frauds or errors in financial reporting.
From this issue, what we notice about poor inventory management is that it actually reveals the strength of auditing standards. ISA 315 forces auditors to recognize weak controls early and respond appropriately. However, the weakness is that once controls fail, the audits become heavily dependent on substantive testing under ISA 330. From our perspective, this increases cost, time, and judgment risk, showing that the auditing is effective but not efficient when the internal controls are weak. Moving on to the next industry by
Thank you,
HUMAIRA.
ALYA. Hi, my name is HUMAIRA binti YAZID. My metric number is 2023804356. Now, I would like to explain in detail about challenges of audit in retail industries. The first issue is inventory management and stock accuracy. As we know, retailers often hold large inventories or overstocking. This may lead to expired goods, damage, and inaccurate stock counts make inventory valuation challenging. Lastly, inventory accuracy, which discrepancies between physical stocks and system records due to theft, damage, or mismanagement, and overstocking of slow-moving items leading to cash flow blockage. Retailers hold large quantities of both fast-moving and slow-moving items, making stock difficult to control. Overstocking may lead to expired, damaged, or obsolete goods, which reduce inventory value. Inaccurate stock records can also occur due to poor stock management and weak systems. To solve this, auditors verify physical counts against system records, review movement logs, and trace anomalies. This ensures business have a clear view of their stock level critical for avoiding both shortage and
That's a good point,
overstocking.
Humaira. In retail audits, we found that the real challenge is not how much the inventory exists, but how quickly the information become audited. The strength is that digital system captures sales and stock movement in real time. However, daily promotions, returns, and transfers means figures can change faster than what auditors can verify. This forces auditors to judge whether system-based evidence under ISA 501 and 330 is still reliable or not. In our case, we believe that this increases detection risk and makes professional judgment far more important than physical
The
counts
next issue
alone.
would be high volume of transactions. Retail business process thousands of sales transactions daily. This will cause difficult for auditors to examine every transaction and rely heavily on sampling. As example, Malaysian retailers use cash, debit or credit cards, Tweet Now QR and e-wallets such as Touch and Go, GrabPay and Boost that make it challenging for auditors to reconcile multiple payment platforms and detecting fraud or error. High volume of transaction is one of the challenges in retail industry. As a result, auditors must rely on sampling, which increase the risk that errors or frauds may undetected. In Malaysia, retailers accept multiple payment methods, which makes reconciliation more complex. This will increase the possibility of errors and fraud when matching sales record with bank
In
statements.
this last issue, what we found most challenging in retail is the sheer volume of transactions. The strength is that auditor standards allow sampling and data analytics under ISA 330 and 240, making audits practical. However, the weakness is that auditors never see everything. This shifts responsibility onto auditors' judgment whether system can be trusted or not. To us, this shows modern auditing is less about checking transactions and more about deciding when the evidence is good enough. Moving on to the last presenter, ATHEERAH.
Hi, my name is ATHEERAH binti KAMARUL IZWAN. My matrix number is 2023840684. For the conclusion, auditing in both manufacturing and retail industries faces significant challenges, particularly related to inventory and transaction processing. In manufacturing, large and complex inventories make physical inventory counts time-consuming and increase audit risk, especially when counts are rushed or alternative procedures are used. Poor inventory management further weakens internal controls and raises the risk of error or fraud. Meanwhile, in the retail industry, inventory management issues and high volumes of daily transaction increase the risk of misstatement. Fast stock movement, multiple outlets, and various payment methods make it difficult to maintain accurate records and reconcile transactions. Overall, weak controls and operational complexity increase audit effort, cost, and the need for strong professional judgment to ensure reliable financial reporting. Next, we are moving on to the recommendations. To address this challenge, companies should strengthen internal controls and adopt reliable inventory management systems such as ERP and real-time stock monitoring. In manufacturing, better planning of physical inventory counts and improved documentation can reduce time pressure and audit risks. For retail businesses, regular stock reconciliation, better segregation of duties, and stronger controls over POS system and digital payments are essential. From an audit perspective, auditors should apply professional skepticism, use data analytics, and leverage technology-assist audit tools to improve efficiency and detection of error or fraud. These measures help reduce audit risk and enhance the accuracy and credibility of financial reporting. That's all from me. Thank you.